everybody, what's up? We are back with another stock analysis, and today we are looking at Coursera. So Coursera just released a allegedly fantastic earnings report. So I'm going to be getting into it, looking at the financials and the hard numbers and seeing how good it really was and talking about where I see the future of the company going. So if you're interested, make sure to subscribe, share this video with every single human being you possibly know. Tell your mom to subscribe, and that's about it. Trying to get to 1,000 subscribers by the time I graduate, which is in a couple weeks. So let's start going. And yeah, let's get into Coursera. So looking at Coursera, if you don't know what they are, online learning platform, college classes, high school classes, they provide things like just class help, studying tools, and things like that. I think books as well. Being a college student and being a person that used a lot of online stuff in high school, I'm not the biggest fan of most of these platforms like Coursera and Chegg, because what will happen is students will buy them for maybe a month or two and then drop the subscription because you don't need it anymore. For summer, or if you're graduating, you just don't need it. So while there are always students, obviously every single year there's more students, it's kind of cyclical in that they don't really have long-term subscribers. Maybe if they could get teachers, or it looks like they're actually doing like job platforms, which could be pretty cool, faculty and staff. So looks pretty good. Definitely better than Chegg at the very least. If you look at the long-term chart though, mostly just down. So let's see about going into some of these financials. So first I'm going to look at the recent earnings report. So this one is the one that just came out 3 days ago. Operating metrics, revenue beat significantly across the board, every single segment. The gross margin increased significantly as well. Looks like their consumer segment had a lot of improvements specifically. EBITDA margin nearly doubled, from what I'm assuming, or sorry, nearly doubled based on estimates, which is awesome. Did way better than they were expected to. Deferred revenue increased as well. They got more cash from their operations. Free cash flow increased. The only negative thing I see here, which if we look, their customers, some of their metrics increased, but the newly registered learners, which is kind of part of the cyclical thing that I was talking about, where students will buy the services, but then only use it for like 2, maybe 3 months and then stop the subscription, which I believe is kind of what this is leaning towards. It did decrease slightly, although based on the growth they've seen in some of their other areas, like total consumer registrants, 18% growth year over year, I think that cancels that out pretty well, and still looks really solid. So after that, we also have their actual financial results. So you could see all the charts here. I'm not going to go into everything specifically, but what I will show is some of the management comments that we've been seeing. And then also there is some outlook on the bottom that we'll look at. So stepping into the role of CEO, a company at the forefront of learning, we've welcomed more than 7 million new learners, making the first quarter record and underscoring the global demand. So this is one thing that will definitely set them apart from a company like Chegg that is mainly just education. They are doing other parts of education, job relevant skills, other education that isn't just traditional school, which I believe is what Chegg mainly focuses on. I reviewed Chegg a couple weeks ago, and honestly, it was not very good, across the board. It honestly looks like they're either going to get bought out or go out of business. But Coursera seems to be performing a lot better, especially highlighting their free cash flow, which that kind of increase quarter over quarter is pretty solid. So now let's take a look at their specific financial statements. So we already saw their most recent quarter was excellent, but let's actually see how they've been performing on a more long-term basis. So first thing is their sales growth is pretty significant every single year. They are seeing big jumps up. And it looks like the last 12 months from their recent quarter has also seen a slight increase. So hopefully we see that continuing. Let's see. EBIT looks pretty solid. They are very negative on it still. However, you can see there has been improvements going from negative 167 to negative 93 in 2 years, which does show they are increasing their profitability a little bit. but they're still kind of far from being profitable um, on the operational level, at least. One thing is also their net income, again, showing improvements over the last 2 years. Not positive yet, but it does look like, based on the, again, last 12-month quarterly estimate, it is pretty solid. Increasingly not negative, which is pretty good sign for a company like this. If we look at the quarterly view, you can actually see they've had the lowest loss in many years, from what I'm seeing. And yeah, since 2019, this is the lowest loss that they have seen, which is good. That means they're getting close to that profitability mark, showing growth in the efficiency of the company, which is outstanding. One thing that we're seeing is the total shares outstanding increasing every single quarter, which isn't great. However, when we're seeing the kind of growth and improvements that this company is mostly showing, I think it's fine. Obviously, they need to get reinvestable cash from somewhere, and selling equity is a pretty solid way to do that. So, anyway, moving on now to the balance sheet. Let's see how they've been doing on this front. So cash is at 750 million and no debt at all. Zero, essentially. Very little, a very small amount of long-term debt, but nothing compared to how much cash they currently have. That is fantastic. Was not expecting that for this company at all, but that is excellent. All of that massive amount of cash that they have can basically just go into reinvesting into the company. Maybe they'll do some acquisitions, possibly, but reinvesting into the company is kind of the biggest thing that they can do, and it looks like that's what they're going to do. But debt situation is phenomenal. No problems here at all. Let's move into the cash flow now. So, looking at their cash flows, operating cash flow looks like it is the highest they have ever seen, as of the last 12 months, which is pretty good. Investing activities, we can see capital expenditures actually took a pretty big dip, which could be a sign of them increasing their efficiency a lot more than they have in the past. Not really seeing any purchase or sales in their investments for the past couple quarters, but either way, things are looking pretty solid. You could see the capex comparison of their March quarters. They've reduced it by about 30%, actually a little bit higher than that. And if we look at the year before, they've reduced it enormously. Or, sorry, they've actually increased it slightly. But still staying within those lines with a ton of growth is pretty solid. So can't really complain too much there. Looking at the financing activities, they have been, again, selling off some of their stock. However, it looks like they have also been doing some smaller repurchases only in their June quarter, for the past 2 years. So we'll have to see if that continues, where it looks like once a year they kind of do larger amounts of repurchases compared to how much they're selling, which could be good. But also, when you're doing where some quarters you're issuing equity and other quarters you're buying it back, I never really see the point of that. For some companies, it's probably stock-based compensation for their employees, which would make sense in this case, but not sure entirely. Anyway, free cash flow is looking like the highest we have seen in a while. Much higher than the last quarter and much higher than the March quarter from the year before, which is pretty good. Um, Much significant increases there. So now looking at the ratios, let's see. So gross margin actually took a pretty big dip about 2 years ago, and since then they've been slightly above 50%. It looks like during COVID, that's probably what happened, was because so many people were at home. Um, their margins blew up, which would make sense. One thing I will say is that from pre-COVID, their margins are higher than then, which kind of hints towards increased efficiency in normal circumstances, which could be pretty good. Operating margin, again, seeing a ton of increases, or a ton of improvements, I should say. More than 10% higher than their 5-year average, which is pretty good. Net margin, same thing as well, seeing a lot of improvement. And if we look at their debt to equity, less than 1%, which is unheard of for most companies. That is very, very good. So overall, with Coursera, based on where their stock price is, which here is their entire chart, they IPO'd, it looks like back in 2021, actually March 2021, which is a pretty rough time to IPO, and they kind of IPO'd into a rough market, but looks like they've weathered it pretty poorly. Now, getting into recently, they have kind of gained some support, especially considering the difficulties in the market over the past few weeks. But overall, not really dropping too much since it looks like the halfway point of 2024. So essentially, the past year, they've been roughly in the same level with their stock price. It does look like they're gaining some momentum, especially with this last earnings report, which is great. We'll have to see where they go moving forward. I think definitely this most recent high will be a pretty big support level to break, um, right around the 980 mark. And then after that, it looks like they did hit right around 1170 a few months before that as well. If they can break higher than those levels, there's a lot of breathing room for them to get all the way up to the high teens, possibly 20s. Will that happen? I don't know. But it's just a possibility based on if they can break these support levels, regain that investor confidence. I would say, very importantly, it looks like the $10 mark. You could see where they touched it here. It was also touched after a earnings report about, well, a couple months ago, where after the earnings fell, they found support there. So I think this 950 to $10 range is a very important level for them. If they can get there and break it, they will most likely see that low to high teens level fairly soon, just based on what I'm seeing. But other than that, that's really all I have for Coursera today. Thanks for watching. Make sure to subscribe if you haven't, and I'll see everybody in the next video.